So, hello, my colleagues. So, I hope everyone is doing well. So, I want to pick up where I left here about why study financial institutions and banking. And we're going to describe how financial intermediation and financial innovation affect banking and the economy. And they tell you here that part three of the book will focus on financial institutions and the business of banking. Okay, so they're going to kind of help giving you like the roadmap. Okay, banks and other financial institutions are what make financial markets work. Without them, financial markets would not be able to move funds from people who save to people who produce or are productive. Okay. All right. So they give you a kind of a definition here of the financial system, and they say it's complex, comprising many different types of private sector financial institutions, including banks, insurance companies, mutual funds, finance companies, and investment banks, all of which are heavily regulated by the government. Well, they weren't that regulated in 2008 when they were running wild and had the big mortgage crisis. So I would take that with a grain of salt, to be honest with you. If an individual wanted to make a loan to the IBM or General Motors, he or she would not go directly to the president of the company and offer a loan. Instead, he or she would lend to such a company indirectly through financial intermediaries. And what is that definition? Uh, Institutions such as banks, insurance companies, mutual funds, pension funds, and finance companies that borrow funds from people who have saved and then make loans to others. Okay, and they tell you that here too. So, why are financial intermediaries so crucial to a well-functioning financial market? Why do they extend credit to one party but not to another? And why do they usually write complicated legal documents when they extend loans? So all these questions here will be answered in chapter 8, which I'm not going to jump to because I'll never find my way back. And that'll give us the coherent framework for analyzing financial structure in in the United States. All right. So what are banks? Banks are financial institutions that accept deposits and make loans, and I assume you all know this, right? This is pretty standard stuff, right? You should all know that, right? The term banks includes firms such as commercial, savings, loan associations, mutual savings banks, and credit unions. Banks are the financial intermediaries that the average person interacts with most frequently. All right, so they give you a little blurb on banks here, which you can read. All right, in Chapter 9, we examine how banks and other financial institutions manage their assets and liabilities to make profits. And then Chapter 10, we extend the economic analysis. In Chapter 8, to understand why financial regulation takes the form it does and what can go wrong in the process with regard to regulation. And then Chapter 11, we're going to look at the banking industry and examine how the competitive environment has changed this industry. All right. So in Chapter 11, they're going to talk about financial innovation, and this is the introduction of new types of financial products such as derivatives and mortgage-backed securities and credit default swaps. Okay. So and also of course here's the electronically, financial services are being done electronic banking now. You can get a mortgage online and all right. So with regard to financial crises, obviously, as I said previously, 2007, 2008, the U.S. economy was hit by the worst financial crisis since the Great Depression because of mortgage-backed securities that were bundled. And the market really dropped, but I took advantage of it and I bought in. As soon as it drops, I buy in. Bear Stearns and Lehman Brothers disappeared. as a as their name, and it's now called the Great Recession, right? If you read up, and it's a good read. You should go on YouTube and learn about it or talk about it. And chapter 12 will discuss these what happened with all those things. So now on to the topic of money and monetary policy. You can see this chapter kind of lays out all the roadmaps. Money, also referred to as the money supply, and anything that is generally accepted as payment for goods or services or in the repayment of debts, is defined as anything that is accepted here, as it says. Money is linked to changes in economic variables that affect all of us, right? So the final two parts of this book examine the role of money in the economy. So I'm going to try to give us all a taste of each section. I think that'll be a good path to take so we see a little bit of everything. Whoops. All right. So let me highlight this again. I screwed up that time. All right, so so from 81 to 82, the total production of goods and services, and so this is an important definition, right? The total production of goods and services, called aggregate output, in the U.S. economy fell, and the unemployment rate rose to over 10%. Right? So unemployment skyrocketed. After 1982, the economy began to expand rapidly, and by 1989, the unemployment rate had declined to 5%. So things got better. 1990, the expansion comes to an end, with the unemployment rate rising to 7%. Now that seems like nothing compared to what we're going through now with this unemployment from the COVID pandemic. The economy bottomed out in 1991, and the recovery was the longest that we're in right now, before the pandemic, with the unemployment rate falling to around 4%. All right, so anyway, they give you a little history of all the downturns and obviously 2001, when the attack on the World Trade Center, things got pretty bad for a couple months anyway. All right, so I will pick up here. I will pick up here in the next video, okay?